Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Beau Eckstein.
Hello, everyone, and thank you for coming to visit episode number 3 of the Investor Financing Podcast. This is the actual first live interview, and I am just honing in my skills. And we have a very special guest today. He's not only one of my good friends, but he's also one of my mentors. So it was interesting when I was looking at his bio just now, because it's like I know him as my buddy, but he's owns 4,100 doors and has done over 28 syndications. And he's an engineer by trade and a motivational speaker. He's written books, best-selling book author. I mean, it's just the list kind of goes on, and it keeps on growing because, he's probably the most passionate person I know. We got Vinney Chopra, my first live guest. I'm very excited to pick your brain. Today's topic is financing for multifamily real estate syndicators, because I think we're going to take a deep dive and look at the financing aspect of these multifamily syndications. And I haven't really seen a lot of people talk about it. So I thought this would be a good way to dive deep. And also, we're also going to get some motivation from Vinney at the same time. So welcome, Vinney, and thanks for coming.
Thank you, Beau. It's such a pleasure, and congratulations on putting this whole platform together where you'll be able to share so much exciting information and helps millions. So congratulations. I'm glad to be your first guest and not the last one. I'll come on when you want me, and you're such a great friend and a colleague, and it's such a pleasure to work with you, bud.
Thank you so much. So not everybody knows your background. I'm sure some of the listeners do know you because you're everywhere, and you're not only are you a great real estate investor, but you understand how to get your name out there and how to build a following, which you've done, and people like you, not just for your investing, but your passion and your motivation, because you have 2 podcasts now, and you're on your 2nd or 3rd book. Can you kind of give us what you're up to as far as that right now?
Totally, Beau. Those of you who don't know me, I'm Vinney Chopra, actually Vinod Chopra, and I came from India originally about 43 years back with $7 in my pocket and a dream to make it happen in USA. And God, with the grace of God, I really believe an Almighty makes us do the things that we do. And I came here with nothing and so forth, and went to George Washington University. I'm an engineer, mechanical engineer from India, worked with Larsen Toubro there, and then came to George Washington University to do my MBA in marketing and sales. Oh my gosh, that just turned my career upside down. I liked the sales and the marketing so much. I sold encyclopedias, Bible books, educational books outside Atlanta, Virginia, South Carolina, all that to earn money for my tuition for the school. And it was tremendous. It just converted me into a more likable, I don't know if that much likable, but somebody who really wanted to be out there in the open to build relationships rather than being an engineer. So it's been a journey of motivational speaking. I grew up with the company, huge, many years, 37 years actually, and invested in real estates on the sideline. Then I became a broker. I'm a California broker. Don't sell and buy homes at all, but I use that skill to really learn the world of syndication, Beau. Yeah. I live right here in San Francisco, near San Francisco, in the small town Danville, Blackhawk, and love to meet many of you.
Thank you so much, Vinney. And we're going to kind of dive, because this podcast is geared towards the financing aspect. And a lot of my friends and listeners that will be joining this show at some point and listening, because we haven't officially launched it yet, but they're interested in the financing component of it, of the ins and outs of financing. And I know a lot of the listeners are multifamily investors or aspiring multifamily investors. So we're going to kind of take a deep dive into like the guidelines and if you don't meet the net worth requirements, some tricks to get, sponsors to become general partners, to be signers for you, right? Because you basically, if you're applying for a $10 million loan, you need a $10 million net worth or partners that have a $10 million net worth. So we're going to kind of dive into that aspect of it. And I think it's going to be pretty good for the listeners. So let me kind of dive into my questions that I've prepared for you. And we'll go from there. Let's see here. Give me 1 second. Okay. So, Vinney, take us back to I think your first deal we're going to start in the beginning. Go back to the beginning. Your first deal was you didn't have the track record. You had a bunch of single family homes. You didn't have any multifamily experience at the time. And I think your first deal, you owner financed or seller financed. Can you kind of walk us through that deal?
I would love to, Beau. Actually, the very first deal was $180,000, 14 units that we closed on Monday. And fortunately, we didn't have to work that hard. The local bank was able to give me loan. The vice president liked me in Odessa, Texas. He still likes me. The other one we closed the same week. We were working on both of them for 11 months, by the way, Beau. But the first one, big one, like 109 units. It also had 101 storage units and a commercial building on 2.33 acre of land. I still remember that. That's about 12 years back or so. But that was a owner financing deal. And let me kind of talk about that because we tried so hard to ask the lenders. And actually, it was also in the crash. The time was pretty bad, 2007, 8, all that time, and 9. So that's when we approached the seller. See, when we don't get financing or you're not having much track record, you should always go and approach the seller if he's motivated or she's motivated. If it's not a big group, sometimes big groups don't like to do owner financing, but mom and pop and small number of units, apartments, owners, they love that because they don't have to pay taxes on the complete sale. That's the other thing. You could plan out this all different, like a loan. You take over the asset. I'm not an attorney, but I would not teach you that. But please talk to your real estate attorney. They can figure out creative ways, to get the promissory note at certain interest rate. Then the interest rate can go full time, like interest only. It can be that way for 5 years or for 3 years. In our case, it was a little different. I mean, because we didn't know anything from anything at all. The seller said, "Oh no, you're not good up. You haven't owned anything that big. You're gonna, bring it back to me after a few years or whatever, right?" So it was 6% interest only. Second year 7%. Third year 8%. Fourth year 9%. And we took it, and the rest is history. We bought that product for $2.4 million, just to let everybody know. And it was 40% down. He wouldn't let us go any higher LTV at all. So, owner financing is a great choice.
That's a good, what's interesting on the seller finance deals, which I think with people that don't need the money right now, right? Then they don't want to pay the highest tax bracket, right? Yes. So I think you set up a normal purchase agreement. You take title as a new buyer, and then you do an installment sale, or at a certain date, right? At a certain date down the road, you actually get legal title, but you're in contract and you're the legal owner, but the deed's not recorded at some point. There's a lot of strategic ways of doing it, or they take back seller finance, but right, talk to an attorney. But I guess having the skills to talk to the seller to kind of show them the tax benefit. And that's I'm diving deep into that because I know, like, if I could say, well, instead of you paying taxes on this full profit, essentially, you can break it into an installment sale. And this is the tax benefits of doing it that way.
Tremendous. I know in that case, 12 years back or 11 years back, he just wanted all the money. So that was not bad. We gave him the whole million. And then he gave us the note. You're right. Yeah. At that time, he didn't mind, paying the taxes, but you're so true. I think this installment sale idea is amazing, and it's very much practiced. Yeah.
Yes. So that's good too for newer investors, right? And the smaller type deals. You're probably not going to see it in the big deals, but just getting started. Sure. You could find a kind of a retiring landlord that likes you. You build rapport with them. Yep. They know you're going to pay your bills and operate the property correctly, and they're willing to take a chance on you. I know a lot of investors do that with single family homes, and it's worked. So that's kind of a great way to get in there. Now, now that you're on your 29th syndication,
yes,
financing has become easier for you to obtain. But I kind of want to walk through, some of the questions I had is when you're now today, when you're analyzing, like you just bought the property for $52 million in Orlando.
Yes.
How do you and your team, how do you evaluate like the best financing option, like to go into a interest only loan? Most of your idea is a 5 to 7 year hold versus somebody who's doing long-term, and that's it. So kind of, can you give us an idea of what you're looking for? I know if you're going into interest only, obviously it's a higher cash flow situation. But what are your thoughts behind interest only? Do you prefer interest only on every deal, or can you kind of tell us why you would prefer it?
Oh, totally, Beau. You're 100% right. As we syndicators, we want to underwrite the property really strongly with good assumptions, because lender also, the bank, Fannie Mae, Freddie Mac, institution, or insurance companies, they always look for a little bit more conservative approach. So it's always great to have a commercial loan broker on your team. On the team means as soon as you are working on your LOI, you're doing your due diligence, financial underwriting and everything, get a broker, like Beau and others, on your team, because they can underwrite it and bless that loan before even the LOI. So that's why I've closed on all 28 deals from letter of intent, LOI, to the closing, final closing, 100% record. And that's because of that. But, there are ways to get interest-only loans are the best loans. Why? Because if you're paying the principal down means that they are getting the interest on the loan for the first year, second year. First year, it's easy to get interest only. I think 1 year interest only just for the asking, the lender gives you that. 2 years, a little bit more. 5 years, they really see who you are. So fortunately, in our case, for the $52 million deal with my partners, Enzo Multifamily, we got a $40 million loan or something, but it was 5 years of interest only, 30-year amortized, 10-year fixed at 3.82%. This is the cheapest money you can ever buy for $40 million, and the bank only wants to get your interest for 5 years, then there is balloon payment, right? That's balloon, or you can refinance it again or sell it. In our case, 10 years in our case. This one loan was fixed for 10. Because of the market, cycles, we are really going for long-term fixed rates, not 5-year fixed, not 7, but 10 or 12 or 15-year fixed, which is a good idea, because now the interest rates are so low, it's good to, go longer term, I would like to say. The big thing is you do want the Freddie Mac and the Fannie Mae. These are the two government branches who give loans for multifamily, for other commercial, also with the 80% LTV. That's 20% down, 80% loan. That's what we got in this property, 52. Actually, price came higher. The appraisal came higher. They gave us more loan. So we had to only pay down 18.16%. I couldn't believe it. They gave us more loan, which is a good thing. But the thing is, you want to go for, these are non-recourse loans. Fannie and Freddie are non-recourse, but you also need to look at the prepayment penalty. Okay, that's the big thing. Prepayment defiance, it's called. These are different terms. financial terms, but make sure that you are negotiating a good term, for the 10 years, maybe after 3 years, I think we have a lockout period of 3 years. But after that, our refinancing is 1% assumption. If somebody buys our property, they take over the loan. Or if we sell it, then our prepayment penalty to pay the loan back is, I think, 1%, something like that.
So as a syndicator on multifamily, your objective is to increase rents, increase net operating income, and to manage the property. And then at the end of your 5 to 7, or your expectations, is to by raising rents, you're increasing values and lowering expenditure. You're now forcing appreciation essentially, and then you're going to sell it, maybe with some potential meat on the bone for another buyer. Mm-hmm. But so during the ownership period, why not pay as minimum as possible? So the interest only period is for 5 years of the 10-year fixed period. So hopefully by year 5, if depending on the market, it might be a sell time, or you might ride out to 7 or 8 years, depending on what it looks like. But the first 5 years, as you're building up as you're increasing rents and so forth, you have the lowest payment possible by going interest only, which gives your investors the highest quarterly dividend payment.
Sure.
And so they're happy. And really, for the first couple of years, you're not going to pay down much interest anyways, right? Like the amortization of the loan. So then, let's say year 6, you end up selling it, and then they've gotten their cash flow each quarter, and they're happy because it's good cash flow. And then they get the equity, potential equity if the property goes up in value because of forced appreciation. So and you can also get a supplemental loan, right? I just wanted to throw that in there, right? After about 2-3 years, we find that we have done forced appreciation. Like you said, we have a lot of different business plan. Whenever we buy a multifamily or any commercial, one should have an exit strategy and also have a business plan, what they're going to do with it, how are we going to increase the income, decrease expenses to increase the net operating income, NOI. And then, of course, from NOI, we take the interest-only payment and CapEx. That's the other line, right? The CapEx is the capital improvement reserve, we call it, or expenses. That brings the cash flow, the net cash flow that we can take to the bank at the end of the month and say, wow, we made so much, and now we can give to the investors 70% of that, 30% keep it ourselves, or give 80%, keep 20, things like that. You're right. But the big thing is the equity gain portion, which will come when we sell it, or another way is to refinance it. As the value goes higher, it's very good to get a supplemental loan in the Fannie and Freddie arms like that. Can you explain how that works briefly? Oh, totally, Bill. A supplemental loan is kind of like as the value increases, then we ask the Fannie or Freddie servicer, we say that, we have already taken care of this, NOI has increased up to this much and so forth. Would you please do the valuation? And now you're able to get a LTV of 70% usually, is the number I've been told. So if the value has gone from 52 million, in this case, it's pretty high number. Maybe we should take 10 million, right? It's some property that we bought for 10, but now it's worth 14 million, right? So that 4 million extra value, 70% of that will be then the new loan. So we can actually, the same Fannie and Freddie can give us a more loan on top of the first loan, which they have. So we don't have to refi at all, because if we pay off that loan, we have to pay the prepayment penalty. But by doing just 1% supplemental fee, they call it also. So you can get more loan on top. Now you got 2 loans. You got the first loan and then the second loan, right, Beau? And that loan, which extra money, we can waterfall is another word we use in syndication. We give back investors money.
initial money, we could give back 50% of it maybe. Now they only have 50% in that deal, and they will keep on getting their cash flows and of course the equity gain when we sell it. But guess what they did now? They got their half the money back or something. They can reinvest that into another asset to make more money. So that's a good way.
Right. That's awesome. So you can also use a supplemental loan for CapEx, right? So you might do 50% to the investor and 50% for CapEx to even raise rents higher, potentially.
Yes, you can. Yeah. This is again, whatever we put in the bridge, in our business plan is the word, in the private placement memorandum. That's the one big document which explains to the investors through SEC ruling, Securities and Exchange Commission ruling. That's the world I live in. And that's where we are able to specify everything in writing so that the investors get all the feeling of it, how you're going to operate when you purchase the asset.
Awesome. Thank you. Now let's dive into the debt service coverage ratio. Sure. And most banks are at 1.2. They will say, we want a 1.2 or higher. But you as a syndicator, what's your kind of your underwriting criteria? Can you kind of go into that?
Our underwriting is more conservative, Bush. Thank you. We go for 1.4 to 1.6. Actually, the reason is the next one we bought $35 million in December, just last month. As you may recall, our DCR is like 2.10. Wow, we loved it. 2.10 is amazing. And we did it because we wanted to do 70% loan, not 80% loan. We feel like correction is coming, right? Nobody knows when the correction is coming, but in the times like these, it's better to put down more so that even if the vacancy goes a little bit higher, we can still break even and do better. We do a lot of pressure testing. We call it pressure testing of our underwriting. What happens, the property we bought, Princeton Park in Melbourne, Florida, it's 97% occupied, 95 to 97. And the bump in rent is about $200 to $400 per month. And we raised $1.7 million from the investors already to do the upgrades of the units. So we have all the money we need. We're going to upgrade and bump up the rents, and so forth. So now our LTV, loan to value ratio, which is very proportional to DCR also, because you want to see that you have enough cash flow to pay the mortgage, right? That's the debt coverage ratio, we call it. So it's so important that we are always conservatively, looking at your numbers. Don't make the numbers work the deal. That's the problem. Sometimes we like the property so much that we manipulate numbers here and there and everywhere, and you can really fudge so much in the cap rate. It's mind-boggling, with the cap rate by just changing a little bit, right, Beau? At the exit, 5-year exit, if you can make it, cheaper, that you're going to sell the property, at a higher price, you can, equity gain can increase appreciably. So answering your question, you're right. You want to really make sure the DCR is 1.25 usually, 1.2 like you said, or 1.4 or 6. 1.6 is amazing.
Yeah, I think if you're going into as a multifamily syndicator, right, that's probably one of the biggest things, right? Like today, how well is my property performing? The rents that come in versus the debt service payment.
Yes.
And your rental income is essentially could pay 2x the mortgage right now. Right. It could pay it 2 times over.
2 times over. Yeah.
So, that's just personally, that's one of the biggest underwriting indicators to me. Like yes. if I'm going to buy a deal, mm-hmm. right? And even that was more of an A- type property or A property, where there's the differences is when you're doing like C properties, right?
Yeah.
Like you're doing a lot of big heavy lifting, big CapEx, big value add play. And at that point, your debt service coverage ratio is probably a little bit lower today,
totally.
but you're betting on next year raising rents and using the CapEx budget to, renovate the property, right? But you still, if you want to play the conservative route in a market that may be slowing down, those kind of value add plays are a little bit more risky today than they were 6 years ago, obviously, because the market may slow down a little bit. Rents may stall out.
Correct.
But on the big value add play deals where you're buying a C-class property, Fannie and Freddie are still going to lend potentially 80% of LTC, 80% of purchase, and potentially 80% of CapEx. Is that accurate?
Yep, that's true. That's true. But the thing is, Beau, also Fannie Freddie mostly go after the more stabilized assets also, right? So we may have to go bridge financing. And let me kind of go back with Sienna Villas. I just wrote a big article, and I think the journal published it from Seattle, and what it was that I bought this property for $3.550 in Texas, Freeport, Texas. I sold it now. I bought it for $3.550, put in the CapEx money and all that through bridge financing. I'll share that with you. And now I sold it last year for $8.5 million. Okay, how did I do that? The property had 16 units burnt when I bought it. When I bought the property, the broker said, Vinney, this seems like a good deal because 140 units are operating, but 16 to make it total of 156 units. 16 are not working at all, but they had a fire. Two little kids got into a closet. They were playing with this lighter from the parent, but thank God nobody, died, right? But they were able to start from the top of the building and then so forth. So I found out later on my sellers gave me cheap because they made $1 million from insurance. So they didn't want to work hard to build it back and wait that long. And they were from San Anselmo, right here in the Bay Area, about 45 minutes from me. It's interesting how the life is, right? And then I bought it, but I bought it from a bridge lender. And my loan broker was no good. I want to say that today, right now. He really did not do his job correctly. And he told me that this bridge loan from some people, I'm not going to say the name, from Los Angeles, they have a fund and they're going to give me the money. This is their first Texas loan, bridge loan to a guy like me. And this was my second property also, so I don't blame them. But at the same token, I knew what I was doing. But the thing is, he said, when it's going to be 6%. Then he said, after about a month, while I'm doing all my due diligence, 6.5%, then 7%, then 8%. Can you tell me? He took me to 10%. How can he take me from 6 to 10? I still cannot forgive him for what he did. and Beau, you are one of the darling. Let me tell you about you also. You gave me a loan and closed it in 15 days, buddy. $8.5 million loan last year. Guys, I want to tell you, if you're looking for a great loan broker, that's Beau Eckstein right here. Right here, I'm telling you. With the local, bank. No, group actually. I can't say the name, but they met me. You brought them in my life. They met me in Blackhawk at coffee shop. They flew that night to Atlanta, and they were able to do everything in their power to close $8.5 million loan in 15 days. That will stick in my mind every time. How well you performed. I was in Japan actually with the family when the loan closed and everything. And I said, holy cow, I have to pay back this Fannie Mae, the notes that I had, and they were giving me some up and down and all that. Anyway, but I sold the property. Everything is done. The loan is paid back. And it was a wonderful feeling, to have that. The big thing is bridge lending for construction or for refinancing or paying off, some very balloon payment or whatever you could say, is very, very essential. And I know you have been able to perform that.
Yes. And thank you for the testimonial. I didn't pay him for that, but that was a good one. But yeah, that's kind of the point of why I wanted to start this podcast, because I've been doing lending for so long and I have all these great contacts and I know all these niche lenders that can do certain things. And I know big time investors that are doing big things like yourself. So I wanted a platform where I could share different strategies and different lenders that do certain things that others won't do, because at some point in your investing career, you're going to need some kind of niche loan, which isn't the easiest to find, or you might need money in a week and it's a big loan. So that's the point of this show, and to pick the brains of investors and find out how they're structuring deals and all that stuff. So the next thing I want to roll into is qualifying for these loans. Obviously, the property's got to qualify, but I found a property for $15 million. I'm looking for a $10 million loan. My net worth is not $10 million.
Yes.
Okay. In the syndication, I can raise the money from my investor pool, but I'm still not going to qualify for the loan. What's kind of a structure? How do you have that conversation with a potential? They would become a general partner, I'm assuming, on all of the
totally
occasions.
They are called principals. You're right. In our world, Beau, because the thing is, we need some signers, where the total net worth of the signers or guarantors is another term, right? Has to be equal to or more than the loan amount. So if it's $10 million loan, our total net worth of 2 or 3 or 4, as many people we need in the pile, and the general partner side, we need their total net worth to be there, and liquidity. You got to have 6 to 8 months of mortgage payment above the capex. That's the other part. You could actually have capex and you say, oh, this is the one for operation also, or the liquidity, they will not take it. So keep that in mind. You got to have liquidity for about 6 to 8 months of the mortgage payments. You got to show that in the mutual fund or things like that. Plus also the capex reserve if you're going to do a lot of heavy lifting, right? But the net worth has to be more than the loan amount. So it's very common. When we started out, by the way, my partner and I, we have very small, net worth, and we had good one, but not that bad. So we did get some other sponsors who were our investors also in the early life. So that's a good way to really look around your circle of friends and acquaintances and retired people too, because retired people tend to have more money. 27 trillion with a T, $1 trillion of retirement funds are in the accounts of USA retirees right here in USA. So all around us, there is so much money, millions of dollars. So it's good to really get in confidence with some people in your family, share with them what you're trying to do, and they would love to be silent partner, hopefully, just signing on the loan, and then you give them a percentage. So in other words, out of your GP percentage, if 4 partners are there and all of them are putting a lot of efforts and everything, then it's 25, 25, 25. But if there is a silent partner who might just sign on a dotted line, that might take 10 or 15%. That's the other way I was going to say. Yeah.
Okay, got it. So bringing in, there's no set number that you negotiate, but you've seen in the past, they're going to get maybe 10 to 15% of the GP's profit side per se.
Right.
That's kind of there's no standard, but that's what you've seen, right? You can negotiate what you can negotiate.
If you're just starting out and they say, hey, you don't know much, I'm putting my name on the line, I want 20%. Guess what? It's actually in one case, this is amazing. We had another partner with my other partner, and he said, oh yeah, I'm coming to sign the loan and everything. He was nowhere to be found. He went to Japan. He went to Japan, and his attorney said, oh no, he's not there. And you know what? That was worst thing happened to us, because Monday he told us Friday was the deadline to close on the deal, Beau. Friday, literally, I remember that. Mariposa Apartments in San Antonio. We bought for 5.5 million, sold for 8 point something. We already sold it. But it was 4 days only. We were going to lose $250,000 hard money because we had extended because this dude will not, untraceable dude, right? Who said that he's going to sign on the loan. So then I called my good friend that morning, Monday morning, and he's been very great investor with me for last 12 years and brought a lot of his friends in my circle. He said within 15 minutes, he sent his financial statement. He loved it. He says, sure, I would like to co-sign the loan. He sent it to my broker and we had the loan approved. Can you believe it? That afternoon. So that was a tremendous thing. So please don't put eggs in one basket. That's what I want to tell your audience. Never rely on one sponsor because they can take you down if something comes up in their life. So have one or two or three sponsors.
That's really good advice there. I think we should do another episode in the next few weeks. And I think we can just dive into kind of go and talk about the whole syndication process a little bit more. And then we can kind of circle back with some of the questions that people might have.
Yes.
Because it is different. It's not me just going out and buying an apartment for $1 million and I'm raising money from one person, I'm getting a bank loan. There's a lot more moving pieces because, during the syndication process, you also, on top of being able to get the loan from the bank, you have to raise the down payment. You have to raise sometimes the CapEx from your investor. So, having the right team and diving a little bit deeper in that. But I think that's going to be another hour right there.
Tremendous. Yeah, we can talk about my plates, Beau, if you would like to. Yeah. The book I wrote on syndication apartment. Of course, a lot of things in this book are for just finding how to buy even 4-plex, 12-plex, 13-plex or 20-plex, not even syndication. If you don't want to do syndication, still you can really learn, So let's dig deeper into it. I'm yours, bud.
All right. Well, okay. How can they find out more about you? How can they get into your mentoring program? Can you give them some contact info?
Oh, totally, Beau. Again, I'm really, really excited because I talk the walk. A lot of people who are getting in my mentorship program. We are building a very big university also, multifamily university now. Multifamily Academy is already running. I do personal coaching every Wednesday, 2 hours in a group mastermind coaching. A lot of my students are cutting deals and syndicating and raising money. I'm so fired up, and they can all join my academy, apply for it. Actually, we don't take anybody. They have to apply, fill out a big questionnaire. We want to know if we can help them or not, first of all. And please text the word learn, 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 to 474747. Maybe we could put them in the show notes also. Text the word learn for 474747. Or if you would like to invest passively with Vinney Chopra and my team of different companies and opportunities in senior living, in hospitality, in multifamily. I'm expanding big time. So that is going to be, text the word invest 2020 to 474747. So invest 2020 to 474747. My website is Vinney Chopra, VINNEY, VinneyChopra.com. And you could email my VP of my academy, John, JON, at VinneyChopra.com. Boy, he's a sales guy, isn't he? He's just telling everything. And also, please buy this book. It's great. It's in audio, it's in Kindle and in print. And the Spanish version is coming very soon. It's almost ready. And my next book is coming, which is Positivity Brings Profitability. My third book is coming, which is Enthusiasm Makes a Contagious. It's so great to be enthusiastic.
All right. And we're actually going to have a website. This is, like I said, we haven't officially launched this podcast. It's going to be investorfinancingpodcast.com. And you're going to be able to go there and you're going to be able to get all the show notes. And you're going to get the links to Vinney's different courses and books, and you can stay in front of Vinney, so you could probably meet him locally if he's flying around different seminars and things and conferences. You can get to meet him and get them to rub a little positivity on you, right? So
I know, this decade belongs to us. I mean, maybe in the next one, we could talk a little bit about mindset, about, law of attraction, about goal setting, about really making things happen. Let's not worry what happened in 2019. Let's worry about 20 to 30, what we want to accomplish in these 10 years.
Exactly. I love it. All right. Well, thank you so much, Vinney. We're signing off, and this will be up and running in the next week or so. And thanks so much, Vinney.
Thank you. Thank you, Beau. See you next time.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.